Nuveen's head of equities and fixed income, Saira Malik, is out today with her new Q2 playbook, sharing it with all of you first. Saira, thank you for being here. Welcome.
Good to see you, Scott.
All right, let's lay it out for people. I mean, what's your best idea here for the next quarter, now that we're facing all this uncertainty and heightened volatility in stocks?
I think, first of all, from a macro point of view, the second quarter is going to have two themes, and that's policy uncertainty and questions over the rate of the economic slowdown. We're already seeing that since the rebound from correction territory a couple of weeks ago, where a little bit of optimism has been injected back into the markets because investors expect watered down tariffs, and that famous word came back, transitory, in terms of the inflation impact from those tariffs. But the second side of that question is what's going on with the economy? The consumer has been the driver of this economy, and we just saw today consumer confidence coming in at a 4-year low. So I think the economy continues to slow. So we're still interested in defensive categories of the markets, like infrastructure, as more and more as we shift to renewable energy and continue to use traditional energy and build out more in the United States infrastructure and AI data centers. I think infrastructure as a sector is going to be very strong. Another area that we like are municipal bonds. The fundamentals of states are very strong. We think community bonds also are producing very strong returns right now, and that's another area of fixed income that we like as a global investment committee.
You are, though, concerned, are you not, about the trajectory of the economy? That you think that the more you keep talking about the weakness in the economy and the more that we talk about consumers feeling uncertain and unsettled and maybe spending less, it becomes a self-fulfilling prophecy.
Yeah, and I think the rate of the slowdown of the economy going forward is going to be the key question. The economy's been driven by the consumer strength and employment markets. First of all, about half of the payrolls produced since 2019 have come from government jobs. So the impact of DOGE is going to be important. And then second, consumer spending, retail sales, consumer confidence have all been weak lately. I will offset that by saying that consumers do tend to be grumpy spenders, so consumer sentiment is not always a sign of what consumers will do with their pocketbooks going forward. But the economy is definitely slowing, and if we continue to see this back and forth and lack of clarity around tariffs, I think that will cause the economy to hit an air pocket. But remember, we still do have tax cuts and deregulation potentially in front of us, so there is upside here going forward potentially.
Yeah, but that's the great unknown, right? I mean, we came into the year thinking that we were all fixated on that. And now we're talking about tariffs every day. And now we're talking about April 2nd. And then after April 2nd, who knows what happens from a tariff perspective from there? So how does that impact the way we should think?
Well, we definitely came into this year on three themes: taxes, tariffs, and deregulation. And it does seem to be we're getting them in that order. I think you're seeing this optimism in the markets over the last week or so because the clarity around tariffs and where they may be targeted is making the markets a little more positive from where they were a few weeks ago. I think if tariff implementation can be clarified to the economy and to investors, that would be a positive. The question marks, though, are who's going to eat the tariffs? Is it going to be the producers, and therefore it will hit their margins and potentially their earnings, or will it be passed on to consumers, which therefore may have less money to spend, and it may hit consumer demand? Those are all the question marks out there. The good news, though, is Powell said last week he's willing to look through the inflation that may come due to tariffs and continue to cut rates. So a bit of a balance here. I think the markets stay in somewhat of a trading range until we get past April 2nd. But if the economy can decelerate at not too fast of a rate, then I think we can make it through this. And those are some of the areas that we like infrastructure, municipal bonds, and small caps could have a catch-up trade in the U.S.